Welcome everyone to our live stream and my take on the FOMC meeting. Now, yet again, the Fed did what people expected, which is to do nothing. This was what was expected. We'll look at the expectations of markets in a moment, and I'll go through some of the stuff which fed into the Fed's decision. But initially, let me just outline what they did. It was a unanimous vote. There was a slight change in language this time around. They are preparing the way, I think, for a cut in September. They actually said the word September. They were guided by a journalist question, of course, but it is looking like September is going to be the time for the first cut. And Powell didn't deny that, but of course they always say it's data dependent. But we'll dig into those comments as well. I think overall, the picture now is very much focused on a soft landing. So previously at previous Fed conferences, we've talked about Powell effectively doing an air punch over the 40-minute, 50-minute press conference. This was a repeat of that, I think. It is looking very much like we're not going to get a big pickup in unemployment. We're going to see, we've already seen inflation fall hugely from its previous peak, and now it's very much on track for meeting the Fed's target later this year, if not early next year. So, overall a pretty good picture of a healing economy, pretty strong growth, good employment, reasonable wage growth, which is slowing down, which is good news for the Fed, and really no big disasters. But there were some interesting comments, so don't switch off, because he made some interesting comments about the election and how that would affect their decision, but also how politics affects what the Fed does, because there are lots of comments online, not a lot of it accurate, I have to say, about the Fed's approach to politics, and so we'll dig into that too. So let's have a look now, and I should also say at the end of this you can ask some questions, and please do like and subscribe. I always have to say that or I get in trouble with Laura. Right, so let's begin, and I'll just share the thing which I usually share at the beginning of these, which is the let me make that a bit bigger, which is the change in the Fed statement. So half an hour before the actual press conference, they come up with this statement which is published, which basically says what they're going to do. Well, they're going to do nothing. But what's interesting is Nick Timrouse highlights the differences from the previous statement. And there are two biggies this time, I think. The first one is that inflation has eased over the past year but remains elevated, is what they said last time in June. In July, they said somewhat elevated, so clearly closer to their target. And the other big one, I think, was that the dual mandate is back. So they're talking about both sides of their dual mandate. Now, dual mandate is full employment and obviously inflation at their 2% target. The point that Powell made repeatedly during this press conference was, okay, so we've got this kind of target. Imagine it like a target in two dimensions. You've got unemployment on the x-axis, you've got inflation on the y-axis, and there's a kind of bullseye where full employment on the x-axis is what you're heading for and 2% inflation is what you're heading for on the y-axis. So there's your bullseye. If you're a long way away from the inflation dimension of things, so if inflation is really high, well, you focus more on that mandate than the unemployment one. If unemployment is way off target and inflation isn't, then you focus on unemployment. So the point is that they were way off with inflation previously. So it was pretty much a single mandate to get inflation back to 2% by whatever means necessary. And now it's become more of a dual mandate as the inflation numbers approach their target. So that's what he kind of stressed throughout, I think, the press conference. But it was a unanimous agreement, which is kind of interesting as well. The other point, I guess, is we just had a data print on the ECI. So this is the Employment Cost Index in the US, and that was pretty reasonable. Now, this is a measure of wage growth in the United States. It's one of the ones which the Fed favors as a good quality measure. And it certainly looks as if wages and salaries for private sector employees has pretty much eased, which is in turn signaling that we're not going to see a wage price spiral. We're not going to see inflation pressures coming from wage growth, which is good news from the Fed's point of view. The other kind of interesting thing, and we'll come on to a question, actually I may as well do that question now. A couple of people have asked me about this, but the Sahm rule, it's not a rule, it's actually an economic observation, which shows that if you're looking at the rate of increase of unemployment in the United States, and there are various statistical munges that go into this, but if it's picking up really quickly from the previous base, then that almost always triggers a US recession, or it signals, doesn't trigger, it signals a US recession. And this indicator is really good. If you go back to 1950, it hasn't missed a recession, which is really unusual. There are very few indicators that work that well. Now notice what's happening right now. The dashed red line is when the Sahm rule triggers, and we're very close to that right now. So there were actually two questions where journalists asked, are we about to trigger the Sahm rule? Let me just dig those out because they're kind of interesting. Sahm rule. Yeah, so what Powell said is kind of interesting. He said, a statistical regularity is what I'd call it. So it's not a rule, an economic rule, that if it triggers, it shows that something's happened. No, it's just it's not an economic rule. It's not telling you when something must happen. So he said, let's focus on what we see. It's not just one number that matters, unemployment. It's all of the economic data which feeds into their decision. So firstly, a normalizing labour market where supply of workers is more in balance with demand for labour. So that's also cooling down inflation. Job creation is at a good level, so we haven't seen the economy crashing. If the job creation was getting very, very weak or going into negative territory, people are losing their jobs in balance, then clearly that would point to an economic hard landing. But that's not what we see. Job creation is at a pretty decent level, but slowing. Wages are moving up at a strong level, but coming down gradually. The rate is coming down, which is also good. And job vacancies have come down, but still high by historical standards. So overall, it's a normalizing labour market is what the Fed's seeing in the US. They're watching carefully to see if it turns out to be more. And if it starts to show signs that it's more than that, i.e. it's picking up really fast, then we're well positioned to respond. By which he means, oh look, we're at above, we're at a very high level of Fed funds, so we've got lots of dry powder. We can really slash rates and get things moving again if we need to. So that was his take on it anyway. So not panicking is the order of the day. So let's just go through some of the other comments which I think are interesting from the actual Fed meeting and the press conference that followed, because I often think that the journalists, not always, but they usually they tease out some interesting truths. One thing that Powell kept coming back to, which is kind of interesting, he often comes up with these particular economic measures and people are scrambling to see what they are. The one he was talking about was PDFP, which is Private Domestic Final Purchases. And he uses this as a measure of kind of demand and the economy being okay. So if people are going out and buying stuff, presumably that signals that the economy is healthy. And that's at 2.6%, he said, so that signals that things are kind of okay. And it's always nice when there's a bit of humour in the Fed conferences, because they're pretty dry, I have to say. I have to watch a lot of them. And this was actually in response to a question, and he said, we're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. And that got a bit of a laugh from the journalists. But we don't change anything in our approach to address other factors and so on. So he then went on to make a really important point, which is about politics. And he says that they conduct their decisions in a non-political way at all times, not just some of the time. So this is really core to his beliefs. The bottom line is, if we do our very best to do our part, if we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger. We'll have price stability, people will find jobs, wages will rise. In real terms, everyone will benefit. So very heartfelt, I thought. This is how we think about it. This is what we do. So he says everything we do during or after the election will be based on the data. And then he carried on. He went on again. There was a follow-up question from the journalist who said, do your economic forecasts and models take into account the two very different economic plans of these two candidates, Harris and Trump? And if so, how? And he replied, no, we do not do that. Very clear. We absolutely do not do that. We don't know who's going to win. Fair point. We don't know what they're going to do if they do win. You know what they say they're going to do is the implication. We don't act as though we know, and we just can't do that. We have our forecast. We can run simulations of different policies, he says, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. We would just not do that. It would be a line we would never cross. We're a non-political agency. We don't want to be involved in any politics in any way. So pretty clear. And he said he's been chairman. I think he said something about four presidencies, but I can't remember exactly what he said. But it was nice to have a bit of humour there. That was nice to see. There was an interesting question from Nick Timmerhouse from the Wall Street Journal. I always love his questions. They're great. And he's written a very good book called Trillion Dollar Triage, which I'm currently reading. And that talks about what the Fed did during the time of the pandemic. And it is astonishing, just the level of chaos that we didn't see, but which the Fed could see in minute detail. It's as if the Fed has an X-ray on the US economy and markets. They can see all the moving parts. And during this free fall period in 2020, when markets were just tumbling, treasury markets were tumbling, so many markets were crumbling, the Fed really had to pull out all the stops. And it talks about all of the things that happened. And also some really interesting personal details, like Jerome Powell strumming his guitar with his dog at his feet. I thought that was a lovely image. That's how he relaxed during these stressful times. But brilliant book. Nick Timmerhouse from the Wall Street Journal wrote it, Trillion Dollar Triage. But his question was, we know that inflation operates with a lag, but what if unemployment operates with a lag? Does that factor into your decisions? And the point here is that we saw that the Sahm rule triggers when unemployment picks up. But the thing is, even after the Fed does one cut or two cuts, unemployment will probably have a momentum. It'll carry on increasing. So do they consider that? And all Powell said was that they watched the labour market conditions quite closely. And also that the dual mandate's more imbalanced, close to the 2019 economy, which was not an inflationary economy. So he was harking back to a period pre-pandemic. So effectively saying that they'd gone back to a pre-pandemic state for the US economy. But what's important is the labour market, he said, is not a likely source of significant inflationary pressures. So he kind of fobbed off the question, which I thought was a shame. Steve Leisman had an interesting question. He's from Bloomberg. And he said, are you waiting for the economy to be able to withstand multiple rate cuts? Because some people are saying, well, look, the rate of inflation is pretty close to your target. Policy operates with a lag. So, you can take your foot off the brake now, or the accelerator, depending on which way you see it. And so perhaps the reason why they're not doing that is because they're planning a succession of rate cuts. So, so hopefully that's not going to make inflation pick up again. And what he said was, we've had this significant decline in inflation. Unemployment has remained low. So it's kind of like a soft landing. And this is a really unusual and historically and such a welcome outcome for the people we serve. So effectively saying, yay, we did it, soft landing. what we're thinking about all the time is how do we keep this going? So really it's a matter of not breaking the economy now that things are looking like a soft landing. So he said, we're not going to be talking about the job's not done on inflation. We think in a base case that policy rates would move down from here, but I don't want to try to give specific forward guidance about when that might be. So no surprises. He wouldn't actually talk about when the cuts would happen or the pace at which it might happen, because it's going to be data dependent, which is uncertain. Usual stuff. Yeah, there was an interesting point about a guy from Fox Business asked this one, Edward Lawrence. If you actually look at the job creation in the United States at the moment, government jobs have really been leading the way recently. So that could be masking an underlying weakness in private jobs. And so the answer to that was, he actually said, he admitted that was true. Powell admitted that was true. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader and the headline number of jobs has come down. So when you look at the whole thing, and I think you do look at private demand data carefully, it actually looks okay. I think that was his point. I think that covers it. Yeah, there was an interesting thing on Bloomberg. Let me share that with you about the market reaction to what the Fed said. So I don't know if you've been watching some of our content recently, but I've got a fund portfolio where I kind of do all my crazy stuff, and it's 10% of my investments, and I usually lose money. But it's fun, and I kind of play around with stuff, and I spend a lot of time thinking about that. But primarily it's there to stop me touching my 90% investments in one fund. And it does that, it keeps me busy. But one of the things I've got in there is a US small cap fund, because a long time ago, 2022, I was talking to a client one-to-one, and I said, look, let's look at the valuation data. And the S&P 600, the small cap index, was not expensive at all. It was super cheap. And there was a huge gap in valuation between small caps and large caps in the US. While the US S&P 500 was a large cap index, was looking very expensive, small caps were looking cheap. So I said, fine, I'll buy a bit of that. So I did. And it's taken a very long time. Currency has gone against me. So the currency has moved quite a bit. Let me just have a quick look at how much that's moved, because it does a nice breakdown on trading 212. Let me just see how big the difference was. Yeah, so the fund I chose was US. Let me share this with you. Yeah, it was USML was the ETF I used, which is an S&P 600 tracker. I liked that index because it filters out unprofitable companies, unlike the Russell 2000. Now, I've actually made good money on that, so it's gone up 22% since I bought. But because currency, sterling, has strengthened versus the dollar, or conversely, the dollar's weakened when I convert it back into pounds, I've lost about 10%. So I'm only up net 11%. Currency's pulled away half of my gain, which is quite annoying. And there isn't a currency hedged S&P 600 tracker in the UK. So yeah, that's my fund portfolio. But my point here is that small caps, there's been a big rotation into small caps over the last couple of weeks. But what we saw today, in response to what the Fed said, and here's the headline on Bloomy, what we saw was a huge rally in all the big mega cap tech stocks. So it's rotating back to the old Amazon, Microsoft, and so on. So all the rate sensitive stuff like Nvidia, Apple, Amazon. And it's looking like the best Fed day session since July 2022, according to Bloomberg. The Nasdaq 100 went up to 3.2%, the best session since February 2023. And then once Powell stopped speaking, both of the indices pared back some of their gains. So anything kind of rate sensitive looks more dovish. When Powell talks, he sounds quite dovish. He sounds like he's going to cut rates. and markets love that, particularly these mega caps, which have been really trounced recently. Because Nvidia has been so volatile recently, you know. Anyway, back to this session. And I think at this point, we can kind of pause and I'll summon my cockapoo, Teddy, and we'll feed him some treats. And I have to rattle the wrong box. Here we go. Ted! Teddy! It's funny because I was walking my dog the other day, just in Holmer Green, and this chap with an Alsatian said, "Oh, I watch you on YouTube. Could you ask a question? Could you do a video about SIPs?" And I never see Teddy, he said. Here we go. So there you go, Ted. Would you like a treat? You're going to have to stand. Do your standing trick. Standing trick. No, don't stand on me. Oh, very good. Clever boy. He's very good at that trick. There we go. Oh, Teddy, clever boy. It's quite good. We do the chapters in AI, and this always comes as dog tricks and general chit chat. There we go. So you're going to go back down, Ted. There's Biltong downstairs. Biltong with Laura. Biltong. Biltong. Yes, he's off. Brilliant. So yes, please do ask a question. Super chats, obviously, front of the queue. We'll push your question to the front. And if you're one of our supporters on YouTube, again, we'll push your question to the front of the queue. And hopefully we'll get around to some of the non-supporters. Mr. JF says the only reason we're here is for Teddy. Dog icon. Thank you for that. I don't blame you. Gerard McCann, one of our community, he says, when will we get to see Teddy? Biltong at the ready. Yeah, everybody knows. Okay. Hedge fund, hello. Nice to see you, Gerard. Here we go. And let me just pull up Laura's document, which has the questions in it. Yeah, we've just migrated to Mattermost from Slack, and so that's been a bit of a scary moment when your entire chat system moves. Here we go. Yep. Nope, don't want that. Laura. Here we go. So, like and share, said that. Oh yeah, and tomorrow, I should say, we're doing the Bank of England. So we're doing it all again tomorrow for the UK. 6 p.m. tomorrow, UK time, is when we're going to do it. And we'll talk about what the Bank of England's done. The actual announcement is in the afternoon, but it gives me a bit of time to think about what they said. The live Q&A has been moved to next Thursday, the 8th of August at 7 p.m. because of the 2 monetary policy meetings. But yeah, super chats and no super chats. So let's have a look at questions which aren't dog related. El Sabio says, do you think they've achieved the mythical soft landing? Well, I mean, if you look at US growth, it's actually pretty good. I wonder if I've got a slide on it. I think I have. Growth, growth, growth. Yes, here's my growth slide. So, I've disappeared. There we go. So this is US growth. And then in the previous press conference, I just love this quote. Someone was asking about stagflation. And Powell answered, I don't see the stag or the flation, which I thought was a great reply. But if you look at growth in the US, it's not bad, 2.8%. Jobs numbers have been pretty good. Let's see if we've got the unemployment data. thought I did have it here somewhere. Yeah, this is the inflation data. So clearly they brought it down to, this is PCE inflation, personal consumption expenditures inflation. These are the measures the Fed focuses on. So when we talk about its 2% target, it's for PCE inflation, not CPI inflation, which many people look at. So pretty close. Yeah, labour market not so tight. This is payrolls. So, I mean, if there was a huge weakening of the US economy, we'd expect this payrolls number, which is the number of jobs the US economy creates net every month in thousands, we'd expect this to be well below 200. But that's not what we're seeing. We're still seeing pretty brisk wage growth. Unemployment is ticking up. But what's also interesting is the supply of labour is growing in the United States. So the participation rate increased a little bit. So if you look at the percentage of the total population who are engaged in work, able to work, it's creeping up, particularly in that 25 to 50-year-old age group, according to Powell. And immigration is also adding to the labour force, which is weakening the imbalance between supply and demand of labour, and cooling wage growth, which is what the Fed wants. So yeah, I think overall we are seeing pretty much what the Fed set out to do, which is to not increase unemployment a lot, not slow down the economy a lot, while getting inflation to cool. How much of that is down to their policy rather than a transient effect, which is switching the economy off and on again, is arguable, but still they've achieved it. Clearly their restrictive policy has had an effect on the economy. It has slowed it down, and they haven't slowed it down too much, which is also positive. So yeah, I think they have actually achieved what they set out to achieve, which is, for the first time I think ever, which is to get a weakening of inflation, of falling disinflation, while not crashing the economy or having a recession, which is pretty cool. But you never know till it's done, right? And we're still not at their target rate, although we're getting close. Another comment. Gerard McCann says Sahm is more reliable than inversion of the yield curve, apparently. Yeah, much more accurate. It doesn't have any false positives until maybe 2024. I guess the other point about the Sahm rule is it doesn't look at the level of inflation, it just looks at the rate of change. So if it's increasing from the previous X months median by a certain rate, I think it's 0.6 percentage points, then it triggers. So at the moment it's getting pretty close to that threshold, but the point is it's coming off a very low base of unemployment. Now previously that did happen in the 70s, I think. Let's have a look at the data, because you can actually see that on the graph. Here we go. Yeah, when was it? Oh, this doesn't show the actual unemployment rate. But I've got another graph that does, but I don't have it to hand, I'm afraid. But yeah, it doesn't take into account the actual level that we're coming off, and that's still pretty low. It's at multi-decade lows. So, maybe that's a mitigating factor. Oh, we've got a question from Gerard McCann. We've got a super chat. Thank you, Gerard. He says, is rotation back to tech stocks a dead cat bounce? Well, personally, I think there will be a last hurrah for these growth stocks, because the Fed is going to cut. We've just seen a little taste of the euphoria which comes from that. I think what will happen is the first cut will be the most euphoric. That'll give the biggest bump to things like Nvidia and the other rate sensitive stuff like Amazon and Microsoft. And then for every cut after that, I suspect what's going to happen is the effect will be smaller. So euphoria on the first one, semi-euphoria on the second, and so on. So I don't think it's a kind of dead cat bounce, in the sense that there will be more cuts and it will have a positive effect on these stocks. But would I give up on my small caps? No. The reason why is simply because of the valuation difference. Every time in the past where there's been a huge disparity between small caps being cheap and large caps being expensive, every single time they've snapped back into line with each other. Now, unfortunately, that might happen due to both of them falling and small caps falling less. But, overall, I'd still be better off from having some exposure to small caps if that were the case. So, yeah, I think it's probably a short-term response. But you can see when the Fed actually does cut in September, there probably will be some euphoria that comes with it. A lot will be priced in because markets are almost certain it's going to happen. So every morning before one of these press conferences, I take a picture of let me move that over, move me down. Here we go. I take a picture of this table from the CME FedWatch tool, and this morning this is what it looked like. So for every one of these rows, you've got one Fed meeting. So that's July, that's today, September, November, December. So these are the remaining 3 for this year. And you can see that the first cut is now for September. And the probability of that, according to markets this morning, was about 90%. So very high. But then look at what happens after that. There's a rate cut every meeting after that until January of 2025. Then there's a pause, then 2 more cuts. Compare that with what markets were expecting in June, just a month ago. It was just 1 cut in September, as we saw today, but then there was a big pause, and then there were 2 cuts in January and March. So you can see markets are getting more used to the idea of inflation falling and the Fed easing off on its policy. So, yeah. So back to you, Gerard. Dead cat bounce? Probably not. But I'm going to stick with this S&P 600 thing in my fund portfolio because that's one I'm going to hold for some time until the valuation gap narrows. That's my plan. The next question is from John Brandon, also a super chat. Thank you, John. And John says, will bond funds go up now interest rates go down? What a great question. And so many people have been asking that question on our chat channel, which is now Mattermost, not Slack. But many people have been asking that. The interesting thing about rates, let me see if I can find one of our explainers on this, because I've got a beautiful graph on that. And as you all know, I love beautiful graphs. But what that showed was the kind of shape of the yield curve in response to policy. And I think it's fascinating. So let me just search. So if you're one of our members, you get access to this funky search tool. So you can search all of our content. You also get to watch our videos on YouTube with no ads in, which is quite good. What drives bond yields? And every week I do one of these explainers, which is for members only. And we've done so many of them now. Here we go. What drives government bond yields? So you get a video that goes with it and some notes. And what's interesting is this. Yeah, let me just move that down a bit. I was wondering if I did it. Yes. No. I was hoping it was going to show the yield curve. No. Ah, pity. That would have been good. But the basic idea is the Fed controls the short end of the curve, right? So anything between 0 and 2 or 3 years is the Fed. So that's your short end of the curve. If there's a financial panic or if there's a growth panic, the Fed cuts rates. As things start to recover, it raises rates again. The long end of the curve is driven by inflation and growth expectations. So if markets expect growth and inflation to go up, the yield curve moves up at the long end. So the short end is kind of related to the long end. There are various proofs that the long end is the compounded rate where you compound the short term for multiple periods of time. So in a sense, the long end should move up if the short end moves up. In practice, it's much more driven by those growth and inflation expectations. So if it's the case that the Fed cuts lead to greater growth expectations, then the long end will move up. But if there is no change in the economic outlook, according to markets, the long end won't move. What will happen is just the short end that moves down. And I think that's actually likely to be what happens. So if you have got a long end bond, if you've got duration exposure in the US, don't expect a massive benefit if the Fed cuts, because the long end of the curve isn't incredibly highly correlated with the short end. If you look at particular parts of the yield curve, the 2 and 3 year, the 3 and 4 year, spaced close together, the correlation is very high. But the further apart those terms are, the correlation drops pretty significantly. And for the short and long end, there is correlation, but it's not very high. So, I don't think that necessarily the long end is going to move down, but the short end certainly will. Yeah, is the long and short of it. Haha. Right, next question is, Laura said keep it short because it's hot. Let's see what time it is. I've lost my clock. I've got to watch. 9:22. Okay, we'll answer one more question and then we'll call it a day. That's a good one. Amish says, isn't the first cut effect already baked into the tech stocks? I think you're right. I think markets are almost certain there's going to be a cut in September. But when it actually happens, the remaining lack of uncertainty, the tightening up of the certainty, going from 80%, whatever it was, 89% to 100%, that would push, I think it's going to push the growth stocks up again. The effect won't be so good or as large as if markets weren't expecting it at all, of course. If it was a surprise and they cut, well, that would be a huge boost to those stocks. But as it is, you're right, we're going from 90% to 100%, so not such a big effect. Thank you, Gerard. He said, good answer. Good. Oh, RSBs from Palma. Very nice. Palma. Beautiful place. Gerard McCann says, my REIT has done well recently. I bought it only in June. There was an initial drop. So there was an initial drop. Always happens when you buy something. Mine is IHR Impact Healthcare REIT. There we go. I think someone's talked to me about that REIT before. Someone's saying good news from the BOE tomorrow. Markets are expecting, well, I think it's 50-50 for tomorrow's rate cut, last time I checked, but much more likely than the Fed, certainly today. No other questions? Okay. Well, look, let's call it a night. Don't forget we've got the Bank of England tomorrow night, 6 p.m. UK time. The next Q&A is moved to the 8th of August at 7 p.m. Don't forget to like and subscribe. Don't forget we'll have a community where you can join us and talk about investment anytime you like. And you can speak to other people who are reasonable people. It was interesting, I had a chat with a client today and he was saying what I like about the community is that they don't have crazy beliefs, really strong beliefs. If you ask a question, they actually come up with a very well-reasoned and reasonable set of suggestions. And they are just suggestions. You know, we don't force our ideology on people. So if you want to join our community, ask questions of the community, which is kind of like a hive brain, which is more intelligent and more knowledgeable than me now. If you want to join us, then just go to our website, pensioncraft.com/membership. We keep the fees very low. We struggle to do that. Of course, inflation's gone up. We haven't put up our fees. So please do join us and join the community. Try it out. You only have to stay for a month. And if it's not for you, you don't have to stay. But many people choose to. So hope to see you on our chat forum and as part of our community. And thank you for joining us. And we'll see you tomorrow night at 6 p.m. UK time for the Bank of England.